You've seen it happen, right? A new asset gets listed on an exchange. The volume numbers look absolutely massive, social media is screaming about it, and you start to feel that FOMO, that pressure to jump in. It feels like a huge milestone, but here's the thing, that feeling can be a trap. So let's really dive into this, because what looks like a golden opportunity can sometimes be nothing more than a mirage. And this quote just hits the nail on the head, doesn't it? That feeling of validation, like, yes, it's finally listed, can make us completely blind to some really serious red flags. So today, we're going to replace that hype-driven anxiety with a calm, repeatable workflow to see what's actually going on behind the curtain of a new listing. And of course, before we get into the thick of it, you know the drill. This is all for educational purposes. It is not and should never be taken as financial advice. You have to do your own research, all right? Okay, let's get into it. So here's our game plan for today. First, we'll break down the listing hype trap itself. Then we'll walk through two absolutely crucial steps: how to verify the source, and then how to judge the market. After that, we'll cover the red flags to watch out for, and we'll wrap it all up with a super simple checklist you can use every single time. All right, let's start with that first big idea, the hype trap. This is all about the massive gap between the excitement of seeing a new listing and the often, let's say, disappointing reality of the market itself. We all know that feeling, that rush. An asset you've been following finally gets on a big exchange, and it feels like a victory. But, as we're about to see, listed doesn't always mean liquid. It doesn't even always mean legit. Now, the goal here isn't to kill your excitement, but to give you the tools to channel it into a sharp, methodical process that actually protects you. Okay, let's get practical. Step 1. This is the absolute foundation, the bedrock of your entire process. Trust, but always verify. And that means you have to go straight to the source. So what does that actually look like? Well, it's a really simple 4-part process. First, you've got to hunt down the official announcement from the exchange itself. I'm not talking about some random influencer's post. Second, write down the key details: which exchange, the exact trading pair, and the date. Third, save that direct link. And fourth, if you search and just can't find an official source, the answer is simple. You label it unknown and you treat it with extreme caution. And let's be crystal clear on this. The distinction is critical. Valid proof is an official blog post or press release from the exchange. Or, even better, a live working link to the market page. What is not proof? A screenshot that can be faked in 2 seconds, a tweet from an unofficial account, or just general market rumors. You have to ignore the noise. And here is a nasty little trap that catches even seasoned traders. Copycats and assets with similar ticker symbols are everywhere. This is why just verifying the name of the asset isn't enough. You have to confirm the exact trading pair from that official announcement. Is it paired with Bitcoin, a stablecoin? The details here matter a lot. Okay, so you've done your homework, you've verified the listing is real. Now comes the most important part of this whole thing: learning to judge the actual market by looking past those big, flashy headline volume numbers. You see $1 million in 24-hour volume. And it sounds amazing, right? But that number tells you almost nothing about whether you can get a good price for your trade right now. So we need to shift our focus away from volume and onto the true measure of a market's health: liquidity. So what in the world is liquidity? Simply put, it's being able to buy or sell something without your own trade wrecking the price. Can you get in or out of a position smoothly? And this all comes down to 2 key pillars: the spread and the depth of the order book. Let's break those down. The spread, that's just the tiny gap between the highest price someone is willing to buy at and the lowest price someone is willing to sell at. You want that to be super tight. And depth? That's about how much money is sitting there, waiting in the order book right near the current price. Think of it like a thick wall of buy and sell orders. You really need both for a healthy market. Okay, so that all sounds good in theory, but how do you actually check for this yourself? How do you go from just hearing these words to actually analyzing a market? It's way easier than you think. First, you just open the order book on the exchange. Then, just glance at the spread. Is it a tiny fraction of a percent, or is it a giant 5% gap? Next, look at the amount of orders on the first few price levels. And here's the $1 million question you have to ask yourself. If I placed my trade right now, is there enough volume waiting here to fill my order without the price slipping away from me? And always remember that last point. Thin books absolutely destroy market orders. So now that we know what a healthy market looks like, let's flip it around. Let's talk about what we want to avoid. What are the clear, flashing warning signs of a dangerous, illiquid market? Let's talk thin market traps. There are 3 classic red flags you can spot pretty easily. 1, a wide spread. We just talked about that. 2, shallow depth. This is when you look at the order book and it's basically empty. A single medium-sized trade could just blow right through it. And 3, jumpy candles on the chart. If you see the price swinging like crazy on tiny bits of volume, that is a huge warning that the market is illiquid. And here is one more critical operational check that is so easy to forget in the heat of the moment. Can you actually deposit and, more importantly, can you withdraw the asset? Sometimes exchanges will open a market but have withdrawals turned off. Look, if you can't get your assets off the platform, it doesn't matter how great the market looks. Your risk just went through the roof. Okay, we have covered a ton of ground. So let's bring it all together into one final, powerful tool you can use every single time you see a new listing that catches your eye. This is it, your calm checklist. 4 simple steps. Number 1, verify the listing with an official link. 2, confirm the exact trading pair so you don't get tricked by a copycat. 3, evaluate the real liquidity by looking at the spread in depth. And 4, check that deposits and withdrawals are actually turned on. That's the whole process. This is how you bring clarity to the chaos of a new listing. If you take only one thing away from all of this, please let it be this. The true health of a market is not in that big 24-hour volume number. It's in the order book. A tight spread plus a deep book are the true signs of a tradable market. And that simple formula, it beats the headline number every single time. So now you've got a framework for verifying a market. But that's really only half the battle, isn't it? The listing is real, the market looks liquid, but what do you actually know about the project itself? For instance, how do you verify the wallet behind the asset? Well, that's a story for another time.